So I can officially say you good morning now because I'm recording it. So and now because we are in Optima, and if you go to your course, link, and you can see that you have the 4 topics. The first 2 topics we discussed on Friday and Saturday last week. And yesterday we discussed about the financing of new ventures, which are the new sources. And today, a major part of discussion would be based on the financial statement analysis, the ratio analysis, basically. And this topic I have already uploaded in Optima in your slides, you can see. And then for the business plan, we discussed that I shall take a legend company, British Petroleum, and I will do some calculations in that company's context. And you can see that I have already uploaded the financial ratios, PP, in spreadsheet folder as well. And yesterday, in start here thingy, I added the course description, well, that's there already, but yeah, in assignments folders, my apologies. In the assignments folder, there is a finance plan example, which I have uploaded. All right, so in the finance plan, you will be required to present, produce, and discuss a finance plan for the next 5 years of a hypothetical company, which we assume with a common denominator that the project will be costing you 100,000 euros to start. And for this, you can use the comparable company analysis, which I hope you remember that it's based on choosing a legend company and then making those calculations and then, articulating those ratios in the context of your hypothetically actual project. All right, and the objectives are very clear here. We want to measure that what type of financial requirements you have, how much financial requirements you have for the working capital, which is for the short-term needs, for your regular needs, and what type of financing you require for your long-term investment. And remember, we have done this topic called capital budgeting exclusively on this long-term investments. What type of capital structure do you require? So basically, this is a debate between debt and equity. All right, and as far as I remember, there have been several occasions in this course when we discussed about the advantages and disadvantages of debt and equity, and we compared them. I think yesterday we spent a sizable time on the discussion about the debt and equity, what are the pros and cons of debt and equity, and how much we compare them, and what are the risks if we have too much of debt, and what are the inefficiencies if we have too much of equity. You will also be required to make some kind of estimation that how much financing you'll be getting internally and how much externally, right? If you look at your internal finance, if I have to give you one example, then your retained earnings are a classic example of internal finance. But when you have the debt, that's an example of external finance. All right. What do you think would be the cost structure? So primarily, what do you think would be your operational cost? What do you think will be your finance cost? Well, the finance cost depend upon the type of finance you have. If you are arguing in the discussion that we shall start with a sizable amount of debt, if you are able to articulate that, you know what, for our project, we will rely heavily on the debt. In that case, what will happen? In that case, your cost structure would change. Not only operational cost will change, but your finance cost will change also. So maybe your interest cost go up, But on the other hand, your tax liability will go down because interest payments are deducted before you pay corporate tax. Okay, so it's a great idea today that if we can have we can familiar ourselves with the actual financial statements of some company. I'm sure you have done it before, but it's not a good idea to see it from a different perspective.
The cost.
It could be possible that the one reason you think can cause you trouble in the future is the uncertainty about the interest rate, because you may be tempted to borrow if the interest rate is low, but your project will be, for example, in this case, you will be making the estimate for the 5 years. All right, so it could be possible that in the future the interest rate can go up. So there is a risk, the interest can rise. But then the good news is that we also have the risk management tools. So basically you can negotiate with the bank that your interest rate, if you can buy the derivative, we use them as the risk management tools, which basically assures you that, for example, your interest rate will not change significantly, even though the market rate can go up. Here I want to give you one example. Many times, people who buy houses, all right, they have the mortgage for 20 years, sometimes for a very long time, okay? And of course, when you buy the mortgage, you will be paying the installment of the house plus the interest you agree. Now, 20 years is a very long time, and maybe by the time 20 years mature, the person who bought the house may retire, and your income will not be, your income stream will not be so consistent then. All right, how can you face the market fluctuations if the interest rate after 10 years suddenly, there's a big spike in the interest rate? In that case, the banks can offer you certain instrument which assures you that, okay, for some time, for a certain period, even if the market rate go very up, you will not be paying more than that. But for that, you have to pay some extra cost. There is an instrument called collars, which allows you that if in the next 5 years, the interest rate go to any level, the interest which you pay us will not rise above this level. But of course, for this service, this facility, when you start agreeing that how much I should pay monthly mortgage, they also charge already some minor, the tiny portion already. It's like you buy insurance, car insurance, yeah? I mean, if you buy the car insurance, what is the logic behind the car insurance? You are afraid that if there is any accident, the damages could be immense to the humans and to the property. All right. Now, if you buy the car insurance, basically, you are transferring the risk from yourself to the insurance company. And in turn, the insurance company is charging a premium from you. All right. It could be possible. One can argue that, hey, for the last 5 years, I haven't met with any accident. Why should I buy the car insurance? You just imagine the car insurance is not legal requirement, but a voluntary choice. All right. Then people may think that we have been driving fine. Why should we buy? But what if you don't buy the insurance and things go wrong? Then the consequences can be horrible. All right. So the same way that even if the interest rate will not go so high, but there's a fear, there's an uncertainty, there's a risk that the interest rate can go up and they can totally cripple your cash flows, especially if you are getting older and now you're almost on the verge of your retirement, and suddenly the interest rate jump from 2% and go up. It will be a big hole in the pocket. In that case, you can buy some financial instruments. All right. There are many instruments. The companies do hedging. They buy some derivative, but even the individuals, they can discuss with the bank that, hey, can I buy the collars? Can I buy the instrument? I'm ready to pay more now, even when the interest rate is low, but I'm afraid of the future rise. All right, pay some 0.01% extra, and we can allow you that for the next 5 years, your interest rate will never rise above this level. Of course, even the banks cannot give you the indefinite promise. So their promise, their service is also time bound. So yes, there are some risk factors to that.
And the second question was what?
So the risk factor also at some stage today, hopefully we shall discuss, and I will try to help you that what discount rate you can use to apply on your forecasted cash flows. Okay. Characteristics, the financial plans are prepared for the full company or even for the project. If you're a startup, there is no difference between the enterprise and the project because you're very small. In the big companies, you also do the project financing. You finance a project irrespective of rest of the company. Financial plans are always prepared in accordance with the overall business plan. Your financial plan have to gel with your business plan. Unless you have a business plan, you cannot have, or you must not have a financial plan. Because the business requirements, the business financial requirements, you will be listing in your financial plan. And unless you have a business plan, how do you know how much money you require? So the first condition, the precondition of a financial plan is to have a business plan. Financial plans are dynamic. We make them in time zero. Time zero means now, all right? But the project would be implemented in several years. Do we remain quiet? Do we keep finger on our lips and just be the silent spectator for all the next 5 years? No, it's not. We keep them continuous. There is a continuous assessment, evaluation, and modification in your financial plan also, all right? So this is a very dynamic concept. And this is where the concept of strategic management comes in the picture. Continuous assessment, continuous changes. Financial plans involve around your assumptions and estimates. So hence some element of subjectivity is also there, always there. As I would discuss with you when I start the ratio analysis topic, that narratives are very important. Financial plans deal with the numbers, all right? But the way you make the calculation of those numbers, what are the assumptions? What are your assumptions that your cash flow will go up in the next 5 years? If you are very flamboyant and very highly optimist entrepreneur, when you produce your financial plan, you can be very, you can push the growth rate of your sales very high. On the contrary, but more you put high, there's a risk. Because when you are pitching, you will face very difficult questions, right? If you say in the pitching, oh yes, my sale will first year, it will rise by 10%. And then the subsequent years, it will go 15, 20, and so on. Then you be prepared for the difficult questions. And so your justification becomes more complicated. So some people are seeing a downside risk more, right? Maybe they are more realistic, or maybe they're more cautious. And they want to have very low profile and don't want to be changing the world kind of people, all right? So with this low profile, they can make these. So basically, when you are estimating your cash flows and the growth rates, your expenses and your profitability and how much you will be investing, not now, but even in the future, they try to be as docile as possible, right? It means that when you are producing these numbers based on your forecast, there's lots of room for subjectivity. Lots of introspection you do. So they're not very objective. Okay. I would say even the business plans are not very objective because it depends upon your perceptions and so on and so forth. Financial plans are more effective when numeric figures are backed up by the relevant narratives. You need to justify. Justification is the key. All right. The numbers are the first stage when you are telling the rest of the world that, hey, this is how our company would look like in the future. But What is the story behind it? In finance, the narratives are super important. And in the empirical research, when students come to me, I know you all are doing thesis. One stage of the thesis is that when the students study review of literature, and when they do the review of literature afterwards, in the same afterward, the end of that chapter or maybe the new chapter, we use the phrase hypothesis. Your hypothesis come from the review of literature. Okay? One of my mantra, one of my suggestion to my students is always that always find the literature which talks not only one side, but the multiple sides. You get my point? If you are only reading the literature, that debt is cheaper, good, better, tax deduction, and so on and so forth, and you make an hypothesis that the company which have more debt will have higher profitability, then you're missing the bus. You're missing the important side that debt can also put strain on you. Okay, so here, there can be multiple narratives. The good thing about having a hypothesis with both plus and minus sign, hey, the relationship is positive, but the relationship can be negative also. The reason is that whatever are your findings will go in accordance to your hypothesis. But if you are stuck to only one side, that no, our cash flow will be rising, debt is better. So if we are only inclined to one side, then when somebody asks you the questions from the other end, you may find yourself in an uncomfortable position, right? So this is why I'm saying that the narrative and the multiple narratives are very important. Okay, so whenever, having the narrative story is very important. We talk about numbers, but the numbers can be interpreted. One more thing I tell my students when they do this calculation is that I would assess you based on three things: calculations, interpretations, and implications. The calculations are that you make the calculations. Like in spreadsheet, you have the data and you make some forecast and then you do some calculation, fine. But that's only 1/3. The 2/3 thing is, in the next phase is how you make interpretations. For example, if your debt to equity is increasing, all right, the one interpretation is that the company would have less finance cost. But the other interpretation of the same number can be that higher the debt, more can be the financial distress cost. If your cash flow is increasing huge, the one implication could be that your operating performance is going up. But then the negative interpretation can be that, are you the company who is giving non-genuine discounts to customers just to increase your revenue? Or are you even making any divestment or disinvestment? Are you selling your assets? Do you get my point? So it's very important that you see the interpretations from multiple angles. And then what are the implications? Implications mean when you have done the different interpretation, you study the number, what these numbers mean to the company's board of directors for their future planning. Are these numbers futuristic? Of course, we do the calculation based on historic number now, but are these numbers helping the board of directors, especially your management board, to make some decisions in the future? So they should be. That is why calculation is one part, how you make interpretations and how these numbers can help the company or how these numbers can affect the company in the future. Implications.
We will make 5 years.
Thought. Yeah, and some market and macroeconomic variables. So when you are making your finance plan, you also incorporate that what type of macroeconomic situation you are in and how likely is that that macroeconomic situation can change. For instance, interest rate is a macroeconomic phenomenon. It's not in your hands. The inflation rate there's nothing much you can do. The GDP forecast, the growth of employment, the factory output, the role of tertiary sector, the primary sector. So these things, which are at the country level, you cannot decide, or even the global level. These, or even that, not only include the economic things, but also the political things as well. If you make a forecast that you are going to start a new venture in Finland, and there's a chances that during this 5 years, definitely there'll be some elections somewhere. And when the elections and the odds are in favor that some very pro-left type of party can come in power, and they can make things complicated for the private enterprises, all right? So if you have these kind of perceptions, then you can also bring into that. Okay.
Or pro-right.
Or pro-right, yes, why not?
Right.
Yeah, any kind of, so,
right.
yeah. So whenever you find that there can be some political change, or is it that the borders are safe? Are we noticing something on our borders? So all these things, or are we even experiencing somewhere else? For example, how does Chinese market look like? Because if there's a problem in China, it's such a massive market. Or how does the US market look like? A lot of eco-political changes are happening in the US. And if those market collapse, or not collapse, but even there's some dent in those markets, that can also have the global repercussions as well. So these kind of things we need to capture. And we also need to take care of some things that are we totally, how can the exchange rate, for example, affect you?
So in the different scenarios, we also, for example, if we have a production, let's say, so in those assumptions, maybe we need to also consider, like, okay, we can run production 24/7, we can run production in lower speed or less days, and then it will change everything except the period expenses.
Yeah.
Then what will be a scenario?
That's very open area, so I leave it to you. So I can only give you some indication that, hey, please, if possible, I can give you set. Please remind me when I go to that stage. I can give you set of points that, please, these things you may consider while playing with the sensitivity or the scenario analysis. So when you're doing what if analysis, for example, your growth forecast is that your sales will increase by 5% a year, and the cost will increase by 3%. What if there is after 2 years, it's the other way around? Would you be able to withstand the situation or not? And these are some of the contents which ideally, I would like to see your finance plan this way. But I don't want to sound very prescriptive. If you can present in a different way, why not? But this will be a good format. Okay, you have 12 sections of your finance plan. Of course, you start with the title. Give some title. I mean, if you say that, give some title. It doesn't have to be very catchy, romantic, kind of poetry title. It doesn't have to be, but give some title. For example, finance plan of enterprise XYZ, and then prepared by, give your name, all right, and then follow the YAMC guidelines if possible, logo and everything. Executive summary is what I expect from you. I forgot to mention here, after executive summary, please give the contents page. You know the contents, different parts, and the page number if possible. I'm sorry I forgot to mention here, but most likely it should be after the executive summary. You know executive summary? Executive summary is like abstract of thesis. But in the corporate reports, in the professional reports, in the consultancy reports, we don't use the word abstract. We use the word executive summary. What do you include in abstract when you write your thesis? What would you write in your abstract? The one, maybe 2 sentences of the background of thesis. Maybe a few sentences about what are you going to explore. Third, Where does the data come from? Which key variables? Maybe 2 sentences. What are your major findings? And finally, what are your main conclusions? Maybe 2 sentences. So when you write your thesis abstract, there's always a research background first. Same way, what is the background of it? Why are you preparing it? Because you want to apply for the funding. You want to have, you want to finance your project. That's the background. Objective. You want to present a detailed description of your finance plan to your potential funders, financiers, and present before them your business and your financial requirements and how does it look like? Different in a more detailed, in-depth manner.
So let's say the executive summary is like they call it like the elevator pitch, like the elevator pitch. Like,
yes.
If you're finding an investor in the elevator, you have only 30 seconds to say what it's about.
Exactly. Okay. Like a good abstract, because I'm an old-fashioned researcher, so I know that the first thing when you send your article, when I send to some publisher, the first thing they check is the abstract. If abstract is not appealing at all, they don't send the article to be reviewed by some professional. And when they refuse you only by reading your abstract, it's called desk rejection. So the letter comes, let's say the old-fashioned way. Nowadays we send emails and we use the online platform. But let's say if I'm a publisher and I receive a journal article and I'm not convinced with the abstract, I will not forward it to you if you are a reviewer in finance, you are in accounting, and so on and so forth. So if the idea, it's very summarized, everything is summarized. But basically, it's a, how to say it? It's, as you said, it's a elevator pitch. Because within 10 sentences, you are showing you're pouring your heart out. Okay. So maybe 2 sentences about the background of the plan. Maybe 2 sentences about what exactly are you going to do in this project, in this plan. 2 sentences where the data will come from, which main key variables you have considered. Like all these are variables: investing, financing, capital ratios, cost of capital, risk associated. They all are variables. All right. Maybe 2 more sentences about what are your major findings. And maybe 1 or 1.5 sentence about what is the overall 1 sentence conclusion of the story. What is your main story? Okay, that's called the executive summary. It doesn't have to be very long. Maybe not even, maybe half a page long. Then comes your corporate mission, vision, and strategic objectives. I assume that these things you have done in some of the courses. Have you? The corporate visions, missions, and strategic objectives.
Yeah.
Okay. If you don't know, please tell me frankly, because I have taught this. Huh?
I don't know.
You haven't done?
No.
All right. Okay. In that case, because this I used to teach in strategic management course long time ago. When I came here, I used to teach strategic management, and for me, these things are very important. Vision, mission. So I would upload this supplementary file so that you, at least by reading those couple of slides, you know what is vision, what is mission, and objective. Basically, when you open any company's annual report, like yesterday, like I would do, for example, BP, they never make the title vision, mission. But when you read if you open the annual report, the first couple of pages are about the speech, written speech, or the address of the chairperson of the company and the CEO of the company. Basically, that reflects the company's vision and mission. Vision is, your mission is, first of all, mission. What is mission? Which mission are you carrying? What are you doing now? What are your major principles? Not things that I'm doing this thing, we are exploring oil from this thing. No. Not operations. what type of philosophy are you carrying now? What is the ultimate mission of your enterprise? Huh? Is that only mission you have?
Or some companies have made fuel for.
Mission is a journey. Mission is a process. What will you be carrying? Which values will you be carrying? Will you be customer oriented? Will you be sensitive to your supplier? Will you be sensitive to the environment? Is your technology, if you're a tech company, is your technology going to help the customers or the businesses to cut down their cost? So what are you doing? What will you be doing? Which principles is your enterprise based on? And what will be your future? How do you see yourself in the future? That is vision. Mission is the mission you follow now. Vision is the mission you will be following in the future. Let's say this way. All right. Vision and mission is very important. And I'm slightly, now we are slightly deviating. The vision is this. Vision is a statement of the future. And to achieve the future, what you see, you need to make some changes now. And that is called your strategic objectives. When you are saying that, I want to be that thing or this thing in the future, there is no crater or a valley. There's no time valley. You take steps towards future. All right. It means that you carry your mission to achieve your vision. And all the measures which you undertake while carrying your mission to achieve your vision are called strategic objectives. If your company's vision is that we want to be the most cost-effective company in the world, let's say, then your mission would be to innovate processes, products, or both. Your objective would be spending significant amount on research and development and improving the processes. You get my point? So vision is a ethos. Mission is a journey to achieve those ethos. And objectives are what exactly on the surface will you do so that you are able to achieve your mission, your vision. All right. And as I said before, that normally the CEO, the chairperson's statement in the annual report, which is right in the beginning, you can see, you can taste you can see the flavor of vision and mission. Okay. As I said before, that they are not given explicitly. Sometimes they are given explicitly. You can even go to the PDF of the annual report and type the word vision and mission. Maybe you get them. But if you don't get them, then believe me, in the first 10 pages of the annual report, you will be having the flavor of what company wants to be. Okay, especially in the speeches given by, the statements given by the CEO and the chairperson. Some example. And I also put my comments here because I was seeing these different companies' mission and vision statements, and I was putting my comments that are they good or bad? So for example, I didn't like the
Pepsi. He's like, we are the world, right? Like,
yeah, even Dell's vision is super vague. They several times the companies by purpose sound vague and unclear. Do you get my point? This is a deliberate attempt not to sound very clear and keep some room for people's imagination. Because here I was super confused. Dell is an IT company. Nature. So I was not sure what is meant by the nature. What are they calling nature? Are they meaning that the business environment? Which nature are they, or are they referring to the wood, forest, snow, sea water, sunshine? What are they referring to? What is meant by the nature? So I was not able to find out. So it's unclear in the use of this word nature. And this is not a small company, it's a Dell. All right?
Yeah, but also the main point is create a company culture. So they are not in the business of creating machines. Mm-hmm. They are in the business of creating a company culture, which might then do whatever.
Yeah.
Not necessarily physically.
Yeah.
Building the machine.
But they could sound clearer, I think. If you know your company, if the CEO and the chairperson doesn't know what the company's mission is, then who else will know? And if they know it, at least say it clearly in a simple, clear words. Okay. But as I said before, that there is sometimes the companies are on purpose want to sounding very ambiguous. Another one.
Perhaps Dell is already thinking on not necessarily making computers anymore.
Mm-hmm. Okay. This is a very old statement. This is some 6 years ago.
So it was like what happened with HP. Mm-hmm. They also at some point they stopped making.
Show something more to you. Strategic vision, the objective. This is the vision, basically. What are the directions of the company? What are the needs? What changes are needed? So maybe I give you examples. Meaning and the use of the word mission. The term mission implies the fundamental and enduring objective of an organization that set it apart from the other organization. What makes you? What is your business? Why are you different? What are the reason to be? If you ask, for example, Microsoft, that why you exist? Microsoft, why do you exist? We have Apple, why do you exist then? What makes you different from Apple? If you ask Pepsi, why do you exist? We have Coke. Mm-hmm. And then they would say, are they speaking the same thing? We are also this, that. Oh, you look so similar. Okay. My question remains, why do you exist then? So what is the reason? What is your existential reason? Why do you exist? That's basically in your mission. And that basically underlines your strategic objectives. And yeah, I made a set of contents that if you want to make a mission statement clear, then say something about them. So there are 9. Are there 9 or more? Yeah, there are 9 things, list of things which I created. Okay. Say something about your customers. Say something about products. Say something about markets, technology. Then sound a little bit futuristic. Are you sustainable? Mm-hmm. Say something about your philosophy, which could be that I want to earn money. Mm-hmm. Self-concept. Mm-hmm. Self-concept means what are the key strategic advantages you have? What do you think are your, how do you say it, your edge over the others? Why you think that you are better than others? Concern for the public image. Say something about community. You don't have to be a massive company to do corporate social responsibility. You can be some small company and do something. Like when we were discussing yesterday, that these small likes or the hits which you get on Facebook page or things like that, when you're doing crowdfunding things. So they also do some image building. Okay? And if possible, say something about the poor employees also. They are also useful. All right. And then I made some examples. When I saw the chairman and the CEO's statement, I found that 3 components are lacking in PepsiCo. So in the PepsiCo's mission statement, imagine they are directly consumer based. They're not B2B, are they? No, they're B2C, right? And in their mission statement, I was literally, for me, it was impossible to find something to talk about the customers. They don't talk about technology. They don't talk about what makes them better than Coke, for example. Mm-hmm. You get my point? So the same thing I did for another company, Royal Caribbean, and I found that out of 9, 5 points are missing. Dell only lacks only one component, that is concern for employee. So Dell's mission was good, even though the vision was very vague, but the mission was clear. However, they didn't say much about the employees. Look at this. This was shocking, You know this company?
Yeah.
Huh? What do they do? And look at that, they are very customer based. They're very customer based. The product and services are very important for them because that's all, they don't give services. Everything is based on the products. And of course, the products are very important because it's a very consumer oriented markets. They innovate and they say nothing about them. So out of 9 components, which I listed here, 6 were missing. Okay, and the Procter & Gamble, they also missed 3. So primarily, these 9s are not any divine, thing which you must follow, but I just make an overall picture that these 9 components must be in the company's mission. Mm-hmm. Concept of financial ratio analysis was majorly popularized by Benjamin Graham in 1928. And just for your sake of information, Benjamin Graham was a teacher of Warren Buffett. I hope you know him. Yeah. And the financial ratio analysis is a part of a larger discipline called fundamental analysis in finance. I used to work in a hedge fund in London. I worked for nearly 1 year. And in our office, there used to be 2 sets of people working. One group was called fundamental analysts. I was one of them. The fundamental analysts who believe in the history, who thinks that history has affected present, and somehow this knock-on impact. So they believe that time is like a wave. So the wave, if you throw the pebble stone in the water, there's a starting point of inflection, but then the ripple effect goes on. So when the ripple effect finishes, that effect is that last bubble is affected by the chain of events in the past, some 30 seconds ago, let's say. So the fundamental analysts believe in the history. They believe that analyzing the company's previous financial statements can give a very important message to them today to make their future planning. So they believe that they like to dig the grave. They are called fundamental analysts. And the fundamental analysts, they make a lot of projection. They make a lot of, they dig data and do the data analysis, and then they make projection for the future. The second group of people is called technical analysts. Technical analysts say that, hey, history is gone. Look at the present stock price movement. The present stock price movement talk about the company's future, right? they say that they allege the fundamental, who allege? Technical analysts allege the fundamental analyst that, hey, you are talking about the company's future, but your neck is always in the past. Whereas we live in present and we can see the futures there. So this is the ideology. And then the fundamental analysts say that your present is a random event. Your present is not benchmarked what has happened with the past. Therefore, you lack knowledge. You lack vision. You only believe in present and you think that just looking at the present, you can see the future. This is very short-sightedness. So there is a big debate. I don't want to go into that, but the technical analyst in the company who we always disagreed, they believe that past is not relevant for the future of the company. Whereas we used to believe, the fundamental analysts, that no, past is very important. How can you ignore the last year's financial statement when you're making a strategy for the future, right? So, yeah.
Your assumption is that people do so.
To some extent, both kind of lenses. Originally, it was in my mind that I let you do this task only based on fundamental analysis. Then I thought that maybe the story will be incomplete and you will not get a chance to learn this skill of analyzing the stock prices of your legend company. So I slightly brought some tangents of technical analysis also in this topic. Hopefully we shall be able to do if the time allowed. If the time doesn't allow us, then nothing much we can do. But now for the rest of the lecture, rest of the day, basically the financial ratio analysis are diagnostic test. When you do the past analysis of financial data, you are actually diagnosing the patient. And I come up with this. What is it? And there are basically 4 health checks. So first of all, a patient, that is a company, complains that maybe we have some financial problem, or not a problem, but or if they're thinking that can we do this successful? Can we be successful in the future? And then we do their 4 fundamental analysis-based health check. Like, for example, the patients can go through the blood test or the blood pressure or the blood count or some other test. We have 4 tests, that is liquidity, solvency, profitability, and operations. So based on 4 tests, we make a comment, we make the interpretation that maybe company has lots of cash, it's a good thing, but I am a little bit worried about the company's solvency, the long-term survival. And then this is the interpretation. And then the third part is implications. The implication for the company for this finding is that you are telling the board of directors, your leadership, that you know what, we should do something. Our liquidity position is strong, no worries, but let's not be too complacent. But we have to work out on our solvency problem. Maybe we are under too much of debt. Should we do something to improve our solvency so that our future is secure? This is called implication. So we do some calculation. Then from the calculation, we draw some interpretations. And then we deliver the message to our seniors or the top managers or the board of directors that what kind of conclusion or the implication they should draw. Data majorly come from, there are 5 financial statements, but we shall focus only on 3. The income statement, the balance sheet, and the cash flow statement. The users of the financial ratios are financial analysts, basically the fundamental analyst. I was one of them, or the investors, the current or the potential. The existing investors can decide if they want to decide to stick with the company or leave it. Or the future investor who you will be approaching, for instance, that would you like to become my investor? They do make use of the financial ratio analysis. The company managers make use of, regulators make it, controllers if you're internal or external. So the many people who make use of these financial statements. And the principal objective is to basically to derive the true financial health of a company through these 4 health checks. So this is the main one sentence objective of the financial ratio analysis, that we want to check how healthy the company is or how healthy the company can be. All right, that's the main agenda. That's the main objective of this. The mindset is that come with the open mind, don't take positions, come with the, see the larger picture, be objective, come with a critical perspective. Okay, that's very important. This is because these slides basically don't belong to your course. In the morning, I slightly modified them for you. So I will come back to this link again sometime later. But what I want to focus is this thing. The first thing is that, the first set of ratios we have is called operating ratios. Okay? This is the first set of ratios. And I will do this, when I do this thing, I will be flipping between 2 more files. The first file is the spreadsheet, which I have calculated, and it's in Optima. And secondly, I would be using the BP as my legend company. All right. So when I discuss these ratios, I shall discuss with you 2 more files simultaneously, so that I don't talk theory. I will also give you some real life taste. So let me open those files. The first ratio we shall discuss is called operating ratio. And the operating ratio is equal to operating profit. And we divide the operating profit by the shareholders' book value of equity. Operating profit divided by the shareholders' book value of equity. The operating profit, the word I think I explained in details yesterday with a small example what operating profit is. Operating profit can be called EBITDA, EBITDA or EBIT. I would say that EBITDA is a gross operating profit. So please go with the EBIT. EBIT is a net operating profit, right? Do you remember we discussed yesterday? So EBIT, my suggestion to you is that EBIT or PBIT, some companies use the word profit rather than earning. So they can call it PBIT, profit before interest and tax. Profit before interest and tax. Or some can use earnings before interest and tax, EBIT. So this is the net operating profit, which we use. Some people call it net operating income. Doesn't matter, as long as you know what I talk. And the bottom thing is called shareholders' book value of equity. This is equal to total assets minus total liabilities. So anything total assets minus total liabilities is called net worth or net assets or the book value of equity. In finance, the good or the bad thing is that we can use many expressions for the same phenomena. All right. And here you can see that the shareholders' book value of equity is also called as net worth or net assets. Okay. And how do you find them? Well, you find them total assets minus total liabilities. This is the company's net worth. All right. Now, if you want to check this ratio and what this ratio shows, this ratio shows that if this ratio comes out to be 0.3, okay, it means that for every €1 invested by the shareholders can fetch them 30 cents of profit. The question is, which profit? Which profit is very important. Operating profit, that profit which only arises because of the company's operations. And why do you invest in a company? You want to invest in a company because of its operations. Imagine your operating profits are very bad. And then the state gives you some subsidies. So you don't pay tax, the state gives you subsidies. And at the end of the day, your net profit is very high. This is not a successful company. because you have become so-called successful because of state subsidies. But when I see your operation, they are dismal. I will never like to invest in a company in the hope that the state would subsidize it. As a pure investor, I would like to invest in a company where I feel, or I have a strong belief that the company can generate profit from its core operations, because I invest in a company because of its core operations. If tomorrow Apple stop doing developing new R&D things, many people will stop investing in Apple, because people, why they invest in Apple? Because they know that for them R&D is in the DNA, basically. They are so much R&D driven company. All right. Now I tell you one example. Some years ago, Apple made a declaration. I think I shared with you that we have 2 billion cash and we want to buy back shares. Investors' reaction was negative to it, because this is a undertone confession that we no longer have good projects to invest in. So please take your money back. If this declaration is given by BP, it will not be problematic, rather positive response. But if Apple is doing it, this can have a negative connotation. It can be considered negatively. So therefore, operating profits are taken rather than net profit or gross profit, right? So how do we find operating profit? Let's go to the company's annual report, which is here. So these are the company's revenue. The total revenue is this much. The first set of expenditures, you can see here with the cursor is, these are basically your operating expenses. And if you remember, we had discussion yesterday, operating profit should not be confused with the production expenses alone. They also includes the administrative, because without administration, the company doesn't work. They also include the selling expenses, distribution expenses, so that all together, these expenses put together are called COGS, cost of goods sold. And as you can see here, the cost of goods sold is basically this block. This block is the cost of goods sold. Okay, so this block between this line, blue line to this line, is the cost of goods sold. And when it's subtracted already, you get profit before interest and taxation. So the company has operating profit. You don't have to calculate. Hopefully in your company case also. So in this case, this 9474 is the operating profit. And you can see the beauty thing, the good thing about the financial statement is that they are in the comparison, yeah? Can you see in the comparison? So normally your income statement is in 3 years comparison, but the balance sheet and the income statement, cash flow statement is for 2 years. So if you want to go for the previous years, then go to the company's archives. You can find in the archive, you can see the last 20, 30 years data also from the income statement, from the annual report. One thing I just noticed that if I see 2016, it's 430, but in brackets, right? In the brackets. So it's a loss. So look, they specify. If something is outside the bracket, it's a profit, but if something is in the loss, it's in the brackets. Companies in the annual report avoid putting minus sign. So they don't want to use plus minuses. So then they use the bracket for the negative thing, okay? So I have 9474. The next thing I need is, net worth, net assets, or what we call more technically, the shareholders' book value of equity. Remember, it's the book value of equity, not the market value of equity. Okay? To see the book value, you need to see the books. To see the market value, you see the market value. I'll come to that market value later. Okay? So,
so comparing the book value versus the market value to tell you how much overpriced the stock is, right?
We use a ratio called price to book ratio, yeah? But I'll come to this later. To find the company's net worth or the book value of equity, we need to go to the balance sheet, which normally is a third or fourth in the, so they all are nearby, so you don't have to travel too far. This is the company's balance sheet. There are 5 statements, but you will be using only 3, okay? So don't, well, actually, I don't even have to calculate it. I already have it. The company's total assets are these many. Sorry, this 276 something. And when I subtract total liabilities, then I have the net assets. Okay. Is this? Yeah. And net assets are called the book value of company's equity. Okay. And when I have this one, 100, 404.
Net assets are the book value.
Sorry?
Net assets
or net worth or the book value of shareholders' equity are same. I explained in the slide. I put that they are also known as. Okay, so if I quickly can. Last year, I was thinking, what is the name? If I quickly divide 9474. Divide by, did I miss something?
9474.
My apologies.
Price? Or what was the
operating profit, 9474 $1 million. Remember, they are in the $1 million. So, which means that 9474 basically is a 9.4 billion. Yeah. How can I remove this thingy now? MS? MC? Whatever. I put a wrong number here.
It's the mark next to the C letter.
Say again?
Next to the C letter.
Okay, this one you mean?
Yeah.
But why it's not going?
This one usually you use. You can use the C.
See?
Ah,
good. So 9, 4, 7, 4 divide by 100. 404 equals 0.09, let's say, yeah?
Yeah.
Or, yeah. So I can say that, okay, let's call it 0.094. Okay. It basically means that the shareholders of the company who invest in the firm, their operating profit ratio is 9.4. So if they invest 100 euros in the company, then they become richer by 9.4 euros at the end of the year. But that's the operating profit because of the company's operations. No, not at the book value, not necessarily.
Because the 100 is the book value.
Because it depends upon us what denominator we want to take. Because both this data is coming from the company's books. So I could easily get the market value also. So maybe if you want to be a little bit more creative, you can also find the market value as a denominator. Okay. But if I say that if you want to see the company's performance based on the book value, then how much is your operating profit ratio? Okay. But nothing stops you. If you want to be more creative and you want to have the denominator as the market value, why not?
In that case, the company is getting a 9.4% return.
Yeah, primarily, yes.
Not you. I mean, not you as an investor, but the company.
Yeah, you can also interpret this way. I think I discussed already with you that this is a operating profit ratio is a very, if I can say so, Puritan, very pure measure of profitability. The very mixed measure of profitability would be your net profit, because that includes operations and also taxation and the finance cost. Now, taxation and finance cost, they are important cost of the company, but they are not really related to the company's core operations. If you see the company's factory, That depends upon the machine, the raw material, the fuel, the power, the salary which you give for getting the skills of your employees. You have the truckload of your output that's going to the delivery point, all right? Then the supplies are coming to your warehouse. That kind of operation, that kind of things are called operations of the company, okay? And you choose to invest in the company primarily because of operations. So I know that at the end of the day, it's a net profit which you have in the reality, all right? But sometimes the image is better than the reality. And the image is that I want to see your operational performance, not net profit. Because as I said in the example that your operating profit can go down, but because the state is giving you huge subsidy, so you don't pay tax to the state gives you a refund. But is it the performance? That's not the performance of the company. That is why we don't consider finance cost primarily. We don't mix up with the finance cost, and we only look at the company's operational performance. The second ratio, which is not really different from this one, is that the only thing different is that instead of book value of the equity, we take the total capital in the base. Total capital means the debt capital, the finance capital, and the equity capital. So which means that we include all type of investors. So you can see here in BP, in the spreadsheet, that first of all, the way I do, you don't have to follow my footsteps. But first of all, I use the word input data, which basically means that to calculate operating ratio, which inputs I require. And I found that because there are multiple ratios here, right? There are 5-6 ratios in the operating profit ratio. So what I do here is that I chose all the data first, which I require. And look at the word. It says operating profit divided by total capital employed. Okay. Now see, the total capital employed is of two types. Can somebody tell me? How many types of capital we employ in the company? Broadly speaking, huh?
The debt and the
equity. Debt and equity, yeah. So equity we already know is this much, the book value, yeah. So all we need to do is add debt. Debt, which means the finance debt, basically. We need to be very clear about not finance debts. Finance debt is what we need to take into account. And then you can see that in this case, I had total equity, and see, I used all the words. So that possibly, which you can see, it's called total equity, net worth, shareholders' equity, or funds, or net assets. Okay, and then I have short-term debt. Yeah, short-term debt is that debt which the company need to give back within a year, and the long-term finance debt or the non-current finance debt is the one which the company would return after 1 year. Okay, and guess what happens here? This is called your total finance debt. You just add them up. Please have a look at the spreadsheet. If you're seeing, it's fine, yeah? So this is the sum of your short-term debt and the long-term debt. And guess what here? Total capital employed. Total capital employed is sum of the equity. And who's 08? 08 is total total finance debt, yeah? So what is 05? 05 is the book value of equity, and 08 is the total finance debt. And when you have the debt, which is here, plus equity, it gives you total capital employed. So now your denominator would change accordingly, okay? Does it make sense? So your companies has equity and debt. Equity plus debt makes total capital. So in some ratios, you might use the equity as a denominator, but in some cases, you can use a total capital, or you can use multiple. Like in this case, I have done multiple measures. Okay. The next measure which I employed to check the and this measure, I would say, that is even more relevant for the startup, the early stage companies, because for the early stage companies, the percentage of profitability doesn't matter, but the assurance that the revenue will come matters more. You know what I mean? In the initial stages, the startup companies, the early stage companies can have losses. But as long as there is a consistent revenue coming, even though the profits are low in the beginning, it's very assuring that at least revenue is coming. The only thing is that we need to cut short our costs and maximize the revenue, but at least some revenue is coming. Some cash flows are coming. So in that case, we use the asset turnover ratio. And you can see that the asset turnover ratio basically tells you how much revenue an asset is generating. So basically, if your asset turnover ratio is this, it basically means that by investing €1 in the company's assets, building, equipment, whatever, the company is able to generate 20 cents of total revenue. And I can say that 20 times 5 is 1, yeah? It means that if the same revenue generates for 5 years, the company would be able to recover its cost. Okay, that is why it says asset turnover, how fast the asset's cost can be recovered. That is why we use the revenue here, because how much money the company can generate that it can cover up its cost. It's on slide 11, okay, in Optima. All right, and for this purpose, we need the total revenue of the company, not the profit, but the total revenue. And by the way, the total capital employed we have, total capital employed is same as total assets, okay? So you can use total assets instead, it's fine. And there's some discussion here, which you can go through. Higher the ratio, better it is. Something like that.
Total capital employed was equity plus debt.
Mm-hmm. Yeah, but if you want, you can use, instead of total capital employed, you can even use total assets. It's fine. It's absolutely fine.
What difference it makes?
Huh?
What difference?
What difference it makes? Well, it depends upon that we invested. This is the financing side. The total capital is the financing side, and the asset is the investing side. So your spectacle change that by investing €1, we get this much, or by spending, or by financing. Financing is that we are getting the money and we are able to generate 20 cents for every €1 we get from our funders. And when you say from the investor's point, the assets ratio, we use the assets, then you are saying that by investing €1 in the asset, company can generate 20 cents. Therefore, the company would take 5 years to recover its assets cost. You can think about the payback thing as well. It needs 5 years. If all remain same, then the company's payback period is 5 years. Right? Plus some discussion. I will not go too much into it. You can go through it if the need be. And if necessary, you can ask me later on. But I want that I should focus on the numbers for some time. And then the next one is called operating margin ratio. So what we do here is we primarily focus on operating profit, which we know we have calculated already, and divide by revenue. Okay. The difference between this ratio and the previous two ratios are that In the first two ratios, we have operating profit and we divide by total capital employed first time, yeah, which come from balance sheet. And in second case, we took total equity, which also come from balance sheet. But here, both figures come from the income statement. Your operating profit is in the income statement. Your revenue is also in the income statement. And the implication of this ratio is that if this ratio is 0.40, it means that every €1 you earn, not invest or finance, not spending or anything, every €1 you earn as a revenue, every €1 you earn as a revenue, 40% is because of company's operations. You get my point? It means that the 60% is not because of operations, but for some financing or other advantages which company has. All right. Higher the ratio, better it is. If I'm purely looking at the company's operational performance over multiple years, then this measure, I don't want to see that the revenue is increasing. That's one thing. I would like to see the revenue is increasing, but more than the increase in the revenue, I want to see which type of revenue is increasing. And then I rather look at the operating profit. That is company's operating profit increasing? Okay, because here, as I said before, your both data sources are coming from the same statement, the income statement. Whereas in the previous three ratios, if you see, the numerator is from income statement, denominator is from the balance sheet. And so was this case, and so was this case. Okay, but here we are comparing revenue with another revenue. So it's like within the same statement, we are making a comparison. And this is called operating profit margin. Okay. And what you need here, operating profit, you have calculated before, you know, and what you need is total revenue. And where is total revenue? Total revenue is here. Total revenue is in your company's income statements, which. Okay. This is total revenue of the company. So, right?
The income statement?
In the income statement, yeah. Okay.
Sorry, which one is it?
This is the income statement.
Yes.
And this is total revenue of the company. Because the formula is operating profit divided by total revenue. And total revenue is here.
And other income.
It doesn't matter. Normally the other income is very negligible. For example, if I have some junk in my, you know, in my warehouse and I sell it to some junk dealer, I can call it other income. Right? It's a very small percentage. It's just any additional income. Or if I have invested in some stocks as a company and I get some small dividend, normally it's a very small margin. But if you want to be very Puritan, no. I just want to see the company's revenue. Well, there's a possibility that you can see this number as well.
So,
yeah, only sales and revenue. But as I said before that, this number, the other income is normally is a very small fraction to it. So, but you can ignore it even if you wish to. Yeah. And then the return on assets. This is slightly, here we slightly get lax. So here what we do, we don't look at the operating profit and then we say that, okay, all right, fine, operating profits are great, but what is the profit overall, you know? And here you have a choice. It doesn't really matter. You can use profit before tax as a numerator, or you can use even profit after tax. Actually, if I were you and I'm calculating this ratio, I would rather look at profit after tax. Okay, because the purpose of this ratio is that, hey, fine, operating ratio, then you have the finance expenses, and then you have the taxes. What is left over finally? All right, I'll make this amendment and I would re-upload this whole file. But now I'm feeling that if I am going to do this task, instead of profit before tax, I would rather use profit after tax. Okay, can somebody tell me the synonyms of profit after tax? Sure. Very interesting ratio. This now slightly we go away from the profits. Profit is a measure of efficiency, but another measure of efficiency is that how well you use your inventory. Okay. Are you making proper use of the raw material? And by the way, the definition in finance of inventory is that raw material plus semi-processed goods plus the finished goods in the stock, but not sold yet. So these are the three things included in the inventory. I repeat, raw material, supply. Raw material is also called supplies, plus the semi-finished or the semi-processed goods, plus the finished products not yet sold. Okay, and the cost of goods sold, I need not tell you where it is now. The cost of goods sold. Can you tell me where the cost of goods sold you can find? Balance sheet? No. In the income statement, we see the money revenue coming in minus expenses. So because its cost is expense, and the balance sheet is about your assets and liabilities. Asset is what you own and liability is what you owe. Okay, but it doesn't show the income and earnings. And if the earnings are in cash, and in the cash flow, we only look at how much cash is coming in or cash going out. Remember, cash and profit are not same or are the same. Are cash and profit same? If a company has huge profits, does it mean that they have a lot of cash? Huh? Yes, any ideas? If a company's profitability is going up very fast, does it mean that the company's bank account is also very rich? That's my point. Similar to it. Inventory days in hand. I have the inventory turnover ratio. First of all, let me tell you, larger the inventory ratio, more activity it shows in the company. And after I calculate this inventory ratio, if I divide 365 days by the inventory ratio, it means that a company, a firm must maintain inventory for nearly 67 days during the year. It means that every time you must have so much of stock in your company, in your warehouse, in your godown, that you are able to run for the next 67 days. Do you get my point? That every time, any moment you enter the company's warehouse and you ask the storekeeper, the store manager, how much stock you have. And he tells you, I have a stock for the next 67 days. Okay?
And raw materials at the same time.
Basically, inventory. It's semi-processed or even the processed, because if suddenly the order comes, the products are ready, so you can just process them quickly, polish them, whatever, and package and supply to the customer. A company whose inventory ratio is high, yeah, is a sign of more activity. And if the inventory ratio is high, which is a sign of activity, and when you divide 365 with the large number, this number will go down. Are you with me? You can't change 365 days. They will remain 365. But if this number becomes bigger, Yeah, and then this number would be smaller. Let's say this is not 5, but 9. Then this number would be around 40. So basically it means that if a company is operating fast, then it needs to maintain lesser number of days stock, because you know that it will keep fast replenishing, right? And this will also reduce your rent and the other overhead expenses. After all, when the things are on the shelf, basically they are in the shelf, right? They're not being used yet. If the number of days are more, this may put more additional cost on you. It means that the goods remain for 67 days in the company office before they're sold. But if this ratio is 40, it means that the shelf period is small. And which stocks, which store, which shops, the shelf period is stock. Imagine you went to a shop, Prisma, some 10 days ago, and you found that the same thing is lying there. And after again, the same thing is lying. Imagine, I'm just simplifying this example. It means that the level of activity is less. But if the level of activity is fast, then the products lying on the shelf or lying in the warehouse, those number of days would shrink. And that not only shows that there is more demand for your products, but it also shows that you have to maintain lesser inventory, which basically means you don't need it, which basically means that your rental and the other admin cost can go down.
Yes, no, but there might be some good examples, because I did this exercise, for example, comparing our company with the competitor. I realized we do have a higher inventory all the time compared to the competitor. But then I realized they have a lot more machines without working, because we make a seasonal product. So we have, with less machines, we have higher output. They can do with more machines, less inventory. So there might be some cases where.
Oh yeah, of course. There's always a narrative behind it. As I said, that these numbers, if you only explain them, just making their numerical interpretation, that will be incomplete. You have to bring the story in. For example, you said that you gave an example of your company and the competitor. So these examples can make your story even more interesting when you are presenting. Of course. And then, sorry. Accounts receivable turnover ratio. Let's believe that the modern business is not purely cash-based. We do sell things on credit, don't we? Okay. So if, for example, Jaskaran comes to me and he says that I want to buy something from me, and I sell, and you buy, let's say, some 20,000 euros purchase from me, and you say that, can I pay you 5,000 now? And can you give me credit for 3 weeks? I'll pay you after 3 weeks. And because I know you, you are my regular client, I say, fine. You know, in very exceptional situation nowadays, only in the retail type of businesses, you buy things and you pay with the card then and there and take the products with you. Normally, if it's a B2B kind of thing, you often give credit to rather in many cases in the retail businesses, for the capital type of goods, you even give the credit to them. But anyways, and I say that fine, I agree. I will show the sales today. Look, I sold goods for 20,000 today, right? It becomes part of my revenue. 20,000 becomes part of my revenue. But guess what? My cash has only increased by 5,000. Look, I sold goods to you, Jaskaran, for 20,000. And let's say my profit margin is 10%. My profit is now 2,000, right? But that is on the assumption that you pay me 20,000 cash and that 2,000 is my profit. But the cash I received from you is only 5,000. That makes the profit and cash separate things. So I recognize that the overall profit on this sale is 2,000. I recognize it right now. But I have not received full cash now. The full cash you will pay me after 3-4 weeks. And you only paid me 5,000. This is why your income statement and your cash flow statement, they would always vary. They will always show different figures. Okay, but the point I want to focus here is that you pay me cash 5,000. 15,000 is a credit sale. In my books, I will call you as my accounts receivable. You are my accounts receivable, which means that you owe me money, you owe me, right? I own a claim on you. Do you get my point? Yeah. So this word is very important, that people who you sell and who have not paid you cash yet, they have not settled the payment yet. You basically own them. I own a claim on you. If you don't pay me, I'll sue you. So I own a claim on you. Hence, you are my asset. See what? If you pay me all 20,000, what will happen? My cash will go up by 20,000. That's also my asset, right? But now, what happened? In 20,000, 5,000 is cash. My cash asset is up by 5,000. But I have another asset called accounts receivable. And I show you 15,000 under that category. So that is also my asset. So my asset still remain 20,000. And the day you pay me 15,000, what will happen? Accounts receivable 0, cash again up by 15. So the point I'm trying to make is that in the modern day world, we based our transactions on credit, and cash credit or cash or credit basically doesn't really affect you too much. Okay.
Until you run out of cash.
Until you run away. Yeah. And see where and where you get this information from for the accounts receivable. Goodness me. Look at that. Trade and other receivable. So they don't use the word accounts receivable. They use the word trade receivable. Okay. And can you see this comes 2 times? Look, it comes in the non-current assets. And it also comes in the current assets. These are the people who bought goods from BP on credit, but they would pay back within a year. But these are the people who bought goods from BP, but they would repay after 1 year. So basically, this is a day light example that, let alone paying you then and there, some customer would pay you even after a year. And this is a normal business practice. Again, it depends upon industry to industry, sector to sector. It's almost inconceivable that in the retail sector, business to customer, like the retail, somebody would give you the credit period for more than a year.
Yeah.
But in the B2B transactions, if you have a joint venture or you have sold things to some joint ventures in Kazakhstan or something like that, it's possible that you get the revenue after 1 year. It's quite possible.
It could be from exploration services.
Yeah.
Like exploration services.
Yeah.
You pay 5 years later.
Exactly.
Start pumping out the oil.
Yeah. So so if I'm doing this task, this is my legend company and I'm doing this task, I would add 2 of these. So always see that, do you have the receivable only in the current assets or maybe also in the non-current assets? So have a look. You might have 2 different figures, then add them up. Mm-hmm. And what else we need here? Well, we need the net sales. Net sales basically is your sales revenue. Yeah. But what is the implication of it? The implication is that when you are calculating accounts receivable ratio, you divide net sales by net accounts receivable. It shows that the accounts receivable turned over 9.5 times or 9.4 times in a year. Okay. It basically means that in one full year, there are 9.4 times when your credit cycle is converted to cash. So there are people buy on credit, but altogether 9.4 times the credit is converted to cash. And it says a higher ratio indicates a shorter time span between making a sale and collecting the cash. A higher ratio, which means that if this ratio is higher and the net, so basically it means that how can you have the higher ratio? Well, the one, if the sales are constant, let's say the two companies, one is a retail company and the other is a machine making company. And let's say they have same amount of sales. I would say that the company which sells goods on retail will have lesser amount of accounts receivable. And because this amount would be less, hence the ratio would be higher, which means that you give less credit time to your, so most of, basically it means that most of your clients pay you in cash. Okay, so higher the ratio, better it is. Now, one thing you should be very careful that if this ratio is larger, I mean, if this ratio is smaller, which means that your accounts receivable pay you for long time, after long time. They don't pay you. Not many people pay you then and there. It basically means that even though it counts profit, revenue, you can have the problem of working capital, cash. Cash could be a problem. It means that you must talk to your banker already that, hey, our business is so that people don't pay us right now. So we might need some emergency funding from you. So we might, and what's the possibility of the, we call it working capital loan or not loan, but credit. How? Jaskaran is paying me not after 3 weeks, but after 3 months, or maybe after 6 months. Well, it means that I would get the money later. It means that I'm exposed to risk. Not the risk that he would run away, but the risk that during this waiting period, I might be suffering from cash shortage. Then what I do, when I sell the products today on 16th of February, and I sent him the invoice and he signed it, I have the copy. Then if the need be, I can immediately send the invoice to the banker and they can give me the cash. So they know that I'm not asking for loan for fun's sake. They have a guarantee. The guarantee is that in the event I have some problem with the bank. All right. Then with those papers on the due date, they can collect money from Jaskaran. So basically bank's short-term loan is secure. All right. So that gives me a lot of relief that even though Jaskaran is paying me after 3 months or even 6 months, basically, if the need be, my credit is secure. Because if the need be, I can show those papers to the bank and get the money from them. It's an operating loan, kind of working loan kind of thing. Okay. But the question is, how much cash I should already agree with the bank that how much money I can need if the need be. That is called accounts receivable days. And once again, if you look at the previous formula, remember we divided 365 days with the inventory turnover ratio. Look, we divided 365 days with the inventory turnover ratio, and that ratio shows how much inventory for how many days you must have inventory in your warehouse. Same way, if I divide 365 by the accounts receivable ratio, it means that It means what? It means that how much cash I must maintain with the bank for some emergency situation. If this ratio is higher, in this case, it looks that there should always be a cash with the bank. So basically it means that you should have a buffer cash requirement for almost 39 days of operation. Today I work in the factory, I run some cost. Tomorrow, day after, at any stage, I must maintain cash in my bank account for the next 39 days of daily operations. And if this ratio is smaller, let's say 3 or 4 or 5, then the number of days will increase.
Yeah, what's here you are is the 38 days is the accounts receivable ratio, but you're not. It's not the cash cycle day.
We're not yet the cash cycle yet.
Exactly. I know, but you don't need money for 38 days because you are going to get some payments.
See, this basically shows that if I make a credit sales to my customers, all right, that will create a cycle of 38 days. So it means that I must have enough cash. Maybe I said the full operating cost, but basically it means that I must maintain cash. No. So what is your interpretation?
But we don't need so much that those assets.
Mm-hmm. Yeah, very right. The next one is the accounts payable ratio. Now, accounts payable, the word is payable. So do you think it's an asset or a liability?
Accounts payable.
It's a liability. It's a liability. See what?
Yes.
I sold goods to just Karan, right? But what if Fernando is my supplier and I ask him that, hey, I want to buy things from you, but I will pay you not now, but after 3 months. All right. Then I owe him money, don't I? I owe him. And whatever I owe is part of my liabilities. All right. And you can see here that, for instance, BP. So after assets, we go to liabilities. Look at that. Just like trade and other receivables, there is trade and other payables. So this is a liability. To customers, you own. To supplier, you owe on routine basis. Okay, so this is an operational liability. And once again, BP has trade and other payables in the current liabilities, and also maybe I can count them basically here as well if you want to, but they're not trade liabilities. So basically it means that BP never buy anything from anybody on credit for a period exceeding 364 days. But for the short period, yes, they buy things on credit, right? So these are not trade payables, but some other payables. I don't know what they have to pay. But the business related liability, the trade payable are these. It means that the company owe $44,209 million to somebody, but for the short period, basically to the supplier, right? Those who supply them some inputs or whatever things. Okay. And what is the implication of this?
It's also important when you see how many days it takes for you to recover when you sell.
We'll come to days now.
And how many days it takes for you to pay when you buy. Let's say if these things doesn't change.
I'm coming on that. Look, this is cash cycle here.
Yeah.
So I'm slowly coming to that point yet.
But not yet to the cash cycle. Because I know I see the cash cycle in days, but also that if you are recovering money quicker than you are paying, means that at some point, if your business grows, you are not going necessarily to run out of cash.
Yeah.
But you're recovering quicker.
Yeah.
Which is the point.
Yeah. That's what I'm saying.
In some cases, it might be the other way. You don't even want to grow because you are going to run out of cash. If you are paying, if you are paying quicker than you are getting.
Yeah. But that's what we say, that we should minimize our accounts receivable day, but we should maximize our accounts payable days, so that we, isn't a good idea that all your cash revenue is collected at the till point, but you don't pay it to your supplier at the till point. So you delay the payment. So you enjoy the credit, but you don't give it. But if the situation is that all your customers, or majorly, your customer don't pay you at the till point, all the inputs which you buy, they demand cash from you right then and there, then that could be really a problem for the liquidity. For example, this Prisma and these people, the other retail stores, I would say at the store level, 100% revenue is cash based. So all the revenue, basically all the revenue is total cash. But if you look at their warehouse, where the store they keep, okay, I don't think that they pay anybody straight away then and there. They buy in the wholesale, in the bulk. It's a B2B transaction, and normally that makes them even better.
Plus they give bonuses. People are actually paying for the bonus.
Oh yeah.
But they won't necessarily return the bonus until. That's why they have so much cash that they make a bank.
Yeah, well. So you have this accounts payable turnover ratio, so which means that it's the total goods sold, the total cost of goods sold is this much, but so that basically means that this cost you incurred, this information come from the income statement, and that divided by accounts payable, people who you owe money, who you bought, who basically are your supplier of inputs, raw material, inventory, whatever you call it. The ratio is 11.075. Okay. And so you can see the interpretation. A firm will like to have a lower ratio as it will like to prolong its repayment. So you want to prolong the repayment period. Okay. And if this ratio is lower, all right, then the accounts payable days would be more. So basically it means that you make your supplier wait for 33 days before you pay them. And that's possible because 365 you can't change, but you can only look for the lower ratio. So if your accounts payable ratio is low, not 11, but let's say 8, then the accounts payable days would be 45, which means that you make your suppliers wait for a longer period. It means that there is no real, if there is a pressure on you to pay for 33 days as against 45 days, then you can relax more if it is 45 days. Well, there are different interpretations to it. We can go and we can have all kind of discussion, but apparently I'm just saying the face value. On the face value, it gives you more leeway because it's a supplier who is on the receiving end, not you. So you make your supplier wait. Whereas here, in this case, in the previous case, your customers make you wait basically for 39 days on an average before you receive the money. So the interpretation is that here, your customer makes you wait for 39 days and you make your supplier wait for 33 days, right? And not only this, we also have to consider the inventory turnover days also, because you bought the inventory as well. Okay, and this is the cash cycle overall. So accounts receivable day, you have to wait before your clients give you money, 39 days. Plus, you must maintain inventory for 67 days at any point of time, minus, which is the accounts payable days, the number of days your supplier have to wait before you pay him, 33 days. So when you find the overall number of days, it comes out to be, let's say, 73 days. This is the cash cycle. Okay. And this is the implication of this.
Yeah, exactly that.